Happy Thursday, everyone. Welcome to the Paul Levine Show. And of course, we have Paul Levine here, which is a good thing, Betty Withrow, and Paul's partner, Fred Sams, today. And today we're going to talk about cost segregation studies. This is a large topic. We're probably going to do this in 2 or 3 parts, but here we go. And Paul, do you want to kick this off?
Well, cost segregation studies do not fall into the cash flow benefit that you want out of real estate or the appreciation. But boy, did they fall into the area of getting income tax benefits. And it's something that you should be aware of. And unfortunately, it's something that most CPAs aren't aware of. I went to a training class for CPAs a number of weeks ago in San Diego, and I was in this tax class that was 2 days and 16 hours. And they talked about cost segregation studies by mentioning the name and saying it gives you some benefit, and they were going to go on. And I stopped them in their tracks because cost segregation studies are a major element, and you're going to learn some of it today, and then we will catch up with more in the future. My partner, Fred Sams, cut his teeth on cost segregation studies a while ago. So I will be talking about the overview, and then Fred will get into the details, and then we will talk about the income tax benefits for you. When you buy something like, and I always love to use the example of multifamily housing, you are buying 3 things. You are buying the land, which is not depreciable because it's supposed to be there forever. If you're ever in an earthquake in Southern California, you're not so sure it's going to be there forever. But trust me, the Internal Revenue Service dictates that it will be there forever. You are then buying the structure. You are buying the ceiling, the floors, the walls, and that's the building standing up, and that will get depreciated according to the Internal Revenue Code by 27 and a half years using what they call the straight line method. Now that means that you're going to take the cost of the structure or the building alone, and that building is exclusive of land and of, we will talk about tangible personal property in a minute, but the structure alone gets depreciated over 27 and a half years. And if it's not residential real estate, if it's other commercial real estate, hotels, office buildings, warehouses, anything like that, it gets depreciated over 39 years. So you take the cost of that structure, you divide it either by 27 and a half years or by 39 years, and then you take the same amount of depreciation every year. You get a little less, no, you get a lot less depreciation than you do when you use the accelerated methods. And we will talk about that after we finish the introduction. So you have, so far, you have the land and the structure that we talked about, and then you also get tangible personal property. You're talking about the ceiling fans, the pop-out windows, the molding. In an apartment building, you're talking about the cabinets in the kitchen and the bathroom, the countertops there as well, the appliances, excuse me, all sorts of other things that make up, give me a second. Thank you. That give you tangible personal property. And those items are normally depreciated, again, according to the Internal Revenue Code, with either 5, 7, or 15 years. And that is not necessarily done by the straight line methods. That can be done by accelerated methods or possibly by bonus depreciation. And we will get into that later. Fred, you're up.
Yeah, as my partner really kind of summarized in a lot of different ways. There are just so many different aspects to cost segregation, and I think what we have to look at that's really key are what are some of the things that drive a cost segregation study, make it useful, make it something to take a look at. Who in those strategies, who can benefit from it? For example, owners of recently purchased or built buildings, owners who have owned a building for several years, lease tenants, estate planning and trust. We're talking about leases, triple net leases really come into play. And when we look at those without just starting to automatically drill down into a specific asset, when we talk about leasing, then the benefit is toward the individual, either the owner of the property or the person leasing the property that is actually paying for those tenant improvements. Because as Paul, and from time to time I may end up calling him Sparky, but that's just my nickname, mentioned, the whole idea behind cost segregation is taking what would normally be 39-year life or 27 and finding those different places and putting them in buckets where they can be depreciated down into anything less than 20 years, but 15, 7, and 5-year buckets respectively. And typically when you speak of what goes in those 5-year buckets into a 5-year bucket as a tangible property item, then that's usually where we're referring to interior fixtures, and Paul sort of touched on some of those, etc. But as I mentioned, what we see a lot of, that there are large and small beneficiaries of cost segregation, and that's driven largely by the asset and the asset size, of course. Self-storage, warehouses, mobile parks, laboratories, dental offices, hospitals, nursing homes, hospitals being for-profit organizations. So cost segregation is a commercial entity that is made available to for-profit endeavors, because then that means you are paying taxes. Retail strips, almost any type of building. I'll take it back to you for a moment, Paul.
The other day I was talking to someone, and one strategy that a lot of people use in investing in real estate is having their either IRA, KEO plan, or other deferred compensation plan buy the asset. And they were talking about doing cost segregation. I said, it just doesn't work, because if you put it in your IRA or KEO plan or other deferred comp plan, you don't get to use that depreciation against other income. And that's really important. So don't ever put something like that into a deferred compensation plan. The thing that you have to remember is that we are deferring, not getting tax savings necessarily, but we are deferring the payment of income taxes for a good number of years. Because what the plan does, or what deferred compensation, what the deferral of income does is, instead of paying income tax now, you're going to pay it in a long time. And that is going to give you an interest-free loan from the Internal Revenue Service, something that they don't like to give out. They don't give out benefits, but this is like an interest-free loan from the government.
Absolutely.
And when you get to the end of it, there is a way to not only defer income taxes, but you can convert some of the ordinary income that you get when you sell the property, taxed at 37%, down to capital gains town taxed at 20%, and that's a 17% savings of all of those items. It doesn't come out to a whole lot of money, but it is a tax saving. So when you talk to anyone about cost segregation studies, don't talk about saving income taxes necessarily, because you're going to defer income taxes. The
That's a
story
good point.
the story I told you before about the class not giving a lot of information on cost segregation means that most CPAs do not know what a cost segregation study is. Most CPAs do not know, and we haven't touched on this yet, and I will now, what bonus depreciation is. Fred, you want to talk about the government bringing in bonus depreciation?
I wouldn't mind. I'd like to go back to a point. The beauty of real estate, in my mind, is that, and if you're listening to the subtle points here, is that it both appreciates and allows you to depreciate it in value. And the depreciation aspect of it is clearly what the commercial property owner is allowed to take advantage of. And so, my partner was mentioning strategies and the notion of deferral. I'd like to come at it from the other direction, which really gets people excited. It does me, is that the value of cost segregation plays off of the time value of money. Time value of money dictates that a dollar in your hand today is worth more than it is tomorrow. And if that's applied correctly, then that allows you to multiply and compound your investment portfolios. There's a few things that people will do with the savings from that cost segregation study. We had a fella that started out with one of his first, and what's interesting, here's a true story to the testament and the power of what this country's about. And I won't, just to mention, he started working in the kitchen, and he worked his way through that restaurant process until he knew it inside and out. And when he was able, by savings, to put his money together and open his first fast food restaurant, the savings that he was able to realize, the tax savings from the cost segregation study, identifying those key components, allowed him, with savings, to apply that toward future investments. And today, and over a 3 or 4 year period now, he's up to a half a dozen L&L barbecues. So if you know and have ever tasted the Hawaiian fast food L&Ls, I know a gentleman there that owns half a dozen of them. And this young man's probably, I've got socks that are older than him, because he's probably barely 25 years old.
Fred, there's something I'd like to add. The fact that you use cost segregation and bonus depreciation means, depending upon the size of the project, you can defer tens of thousands of dollars in income taxes for years and years and years. Now, say you go to buy the property and it's going to have cost segregation done to it. And number one, the bank might give you a loan that they wouldn't have given you otherwise.
That's another thing.
Cash position. That's
absolutely
really important. Number two, say you're going in and buying a fairly large self-storage facility that's on one side of a lot, and you have an empty lot on the other side. That savings of tens of thousands of dollars could help you buy that second property. You don't have to build now, you can build later. And by the way, when you build a property as opposed to buy it, cost segregation can become a little bit more of a benefit, because there are ways that you can build the property that could give you more tangible personal property than if you just bought the property the way somebody else built it years ago. And the third
absolutely
thing, and I also love to say this, and Fred's not going to say absolutely when I say this, you can also take that wonderful vacation with someone you love. It gives you a lot of money. You have to pay it back later, but you've got a lot of time. And going back to cost segregation, if they don't know that it'll give you benefits in the beginning, they don't know it's going to give you benefits in the end by turning ordinary income into capital gain.
Absolutely. Well, there's a few things that were said there, and I wanted to step back. My partner was a CPA for over 50 years. And one of the values to our relationship in the business model is that he has that in-depth knowledge of taxes, extremely creative individual. And so the way that he looks at different clients and everyone's situation is so different, and how you can apply a tax and depreciation analysis to a situation are all different, and they're all very unique. We're not an accounting firm. We provide through a company called CSSI the engineering services necessary to properly apply cost segregation. And so while this becomes a challenge, because sometimes somebody's tax professional may opt to apply a cost segregation, the IRS highly recommends that an engineering level study be done, as opposed to an appraisal method, as opposed to a desktop. And truly, you have to put that in some frame of reference. If I were going to a heart doctor, I would not consult my foot specialist unless somewhere or another my heart and my foot had something. No, I'm just joking, but you get what I'm saying. And so we work with your tax professional to provide him those calculations that they need to properly apply to your situation, whether you're actually capitalizing or expensing, and when that makes the most sense, and having the numbers correct. As my partner alluded to, this is also a strong tool to be used by mortgage professionals, particularly now when we're at a challenging point right now with interest rates being so high, and really trying to pencil out deals for investors. So now where you can show by using bonus depreciation, and again, bonus depreciation, what kind of is that? Well, in my mind, and we'll have two different ways of presenting it, but again, it's taking the fact that you've taken things from 27 or 39 years worth of a depreciation space, and you've brought percentages of them down into 15 and 7 and 5 year buckets, if that's a good term to use.
Fred, let me throw something in. Beside those three buckets, you can take that bonus depreciation that Fred just talked about, and that bonus depreciation before 12/31/22 was taking 100% of the cost of the tangible personal property, those assets that could normally be depreciated over 5, 7, or 15 years, and depreciated in the first day that you buy those assets, that they are placed in service. That's an important phrase. So you can get a tremendous amount of depreciation using bonus depreciation. Then the government, in its inimitable wisdom, decided to phase out bonus depreciation by 20% a year. So if 2022 was 100%, 2023 was 80. Our current rate in 2024 is 60, and then it will go to 40 and 20 and 0. But there is a bill, bipartisan bill, running around in Congress, and it's been running around for a couple of weeks already. And I heard today it's probably going to run around for another couple of weeks until they should pass it, reinstating bonus depreciation to 100% until 12/31/24, or maybe 12/31/25.
So if I can jump in on that, if I can jump in just to add what starts to make that significant, guys, is if you've taken and you were able to reduce now, let's say an additional 30%, just to use a round number, down to any one of those 15, 7, or 5 year buckets. Bonus depreciation at 100% allows you to take all three of those, move them down into the first year, and apply them at 100%. I mean, you have to get the gravity of that. That creates a real steroid, 10x. Excuse my language. That created a real 10x effect for investors. And the other thing is when I initially got involved with Cost Seg around the 2016 area, give or take, you were only able to apply bonus depreciation to new structures. Now this is any purchase. And it does not have to be ground up construction or brand new. And so it has really created a tax strategy that is huge. But let's look at this for a minute, because what's significant about what I believe my partner and I offer is you have to first look at cost segregation and imagine you're looking at a triangle where cost segregation is at the base. And then above that, you may have heard the term the CARES Act. Well, there were a few things that were incorporated by Congress through the CARES Act. And one of those, on top of the layer of cost segregation, which we're just touching the surface on, is qualified improvement. And this applies to any commercial property, the ability and the benefits from accelerating depreciation on any property that has a 39-year life. And so it's really significant to talk to someone, an outfit that's involved in cost segregation, and I have to pat us on our back because we're listening to the application. Someone comes in and they're buying a space that was formerly a restaurant, and they're going to put another restaurant on it. Well, that's significant to different things that they can depreciate from that. Folks that are building or doing renovations, there are certain places there where an item called partial asset disposition can be applied. And that, in its simplest form, is taking trash, stuff that you would otherwise take down from that renovation or rebuild and put in the garbage, and it still has a usable tax life, which becomes cash.
Excuse me, boy. I got to step in on this because this is one of my biggest things that I get upset about. When you used to use regular depreciation, you would start out with the asset at 100%. And if it's a 10-year asset, you depreciate it over 10 years, equally or not equally. And at some point in time, you have not fully depreciated that asset. So it has what we call a book value, the cost minus the accumulated depreciation. And if you break up the building and throw this stuff away, you're definitely supposed to write off the stuff that wasn't fully depreciated because you don't have it anymore. You don't own it anymore. It's not giving you any advantage anymore. And I love the people that brought in cost segregation because they made this a whole thing with a new title. And basically, it's just good accounting. And that's something that you've got to know because your CPA has to want to be creative, has to want to get you that last dollar of savings of income taxes. I pride myself on being creative. I say something, and this is all self-serving, that talks about my now I don't do anything and that is that I have more income tax education, knowledge, experience, creativity, and expertise than any other person doing what I do. Nobody else was a CPA for over 50 years. And now I'll do self-serving for both of us. We're good. And we work with an absolutely wonderful cost seg company called CSSI. And they send, just like everybody else, but when you do a cost segregation study, they send people to the site. They've got to walk through it. They don't just do it by picking out numbers out of the air. And they are professional, and we are. And we could really, really help you.
It's an excellent combination for sure, as my partner was alluding to. The notion of consultative uh, selling and recommendation. We're building long-term relationships here, so it's really important to be able to get involved with clients as they're even considering. I take and do proposals with clients and say, you know what, I'm thinking about buying this strip mall area. It's got about 50,000 square foot worth of parking area. I'm going to have to put some work in there. It's got one anchor, Whole Foods or whoever, for example, McDonald's, whatever that might be, and several other single tenant to make a multi-tenant in strip mall, and roofing, signage, etc. And we start to help unpack by proposal what that would look like, where those items are going to be best to be used in an expense versus a capitalized situation.
Let me throw something out because I was amazed at this. The shrubs that are around the property, the trees that are around the property.
Landscape, absolutely.
All of the landscape, the stuff, the parking lot. It's not just a parking lot that's 50,000 square feet and you can't get any benefit from it. There is benefit from it. And you can get bonus depreciation on that benefit. So we're talking about a big number. Assume a big company, a big business selling something, Whole Foods Market, like Fred talked about. I was going to say Macy's, but I don't think they're around anymore. But you get the idea. And these companies all do it. And just think about all of the stuff that's tangible personal property in a restaurant, beside all of the tables and the booths and the chairs and everything on the walls. Then you walk into the kitchen and you have you have cooking facilities, you have machines, you have stoves, ovens, you have dishwashers, you have all of that stuff. And all of this can help you.
Absolutely. So I think what's significant to consider too is the different directions by which something like this makes sense. If you're the investor, you're looking, you're looking for, and depending on the type of investor you are, if you're looking at being a value add investor, by the benefit of depreciating the different items that have gone into your investment, you're in fact, at the end of the day, you're going to be creating a cash flow stream for yourself because you're taking and looking at opportunities in ways that you never did before. And so I always encourage our investors, as they're considering looking at an opportunity, let's talk about it, because there's a lot of hidden opportunity behind what appears to be from what it does not appear to be. Let me just say that. So
you guys keep trying to get in and we keep talking. So I guess you want to come in and do something or say something.
My apologies.
No, that's perfect. I think that what I'm hearing here is you're inviting people to come and with their projects and talk with you, and you'll review what their situation is and give some very qualified advice based on 50 or 60 years of experience, right? So,
and I particularly can speak to their accountant using his or her language, stuff that they were brought up on, because I've done it, I've been there, and I've done it longer than just about anybody I know.
That's perfect. And Betty,
yeah, we end up, if I might just throw in, Greg, to your point, and thanks for bringing that out. What we like to end up, or what our goal is to create a proposal that really does take and break down what that savings is. And let's face it, there are situations, and I'll let Paul speak to that in a little more detail, where a cost segregation study may not work. If you've got a tax liability, it's going to work. There are, and so as we consider that, we have clients that are very thankful for us helping them understand their situation or working with their CPAs to better understand their situation. So not every opportunity is one where someone may consider having a study done, but in each situation, they better understand the opportunity. And that's very important to us.
Guys, you coming back?
Yeah. So Betty, do you have a question or a comment here?
Well, I would say that taking advantage of the benefit that is very serious one of having all of that experience and the strategic thinking that these gentlemen are talking about. If you're thinking about getting into real estate investment, you need to talk to these guys because they know their stuff and they think of things in ways that other people don't. And that creativity can really do good things for you. So get in touch and find out, what you can learn, what you can do, and you may be able to do a lot more with your investment capability than you realize at the current moment by working with these guys and figuring out how to do it the best possible way.
Greg, I will ask you to talk a little bit about the Bible of real estate.
Yeah. Okay, so the reason Betty and I are here is we've been helping Paul publish his book, The Bible of Real Estate. And there's on that little scrolling thing, the Bible of Real Estate .info is a place where you can get access to an early version of the book. We haven't actually launched it. We're still making some final changes, and we're going to launch it to all places where you can buy books. So, and Paul is interested in speaking, and Fred too, I think, making appearances at conferences and shows, anywhere where you can talk about real estate investing and tax and all of that, cost segregation. Paul has a daily daily article he puts out on LinkedIn, and you can subscribe to that. There's a link to subscribe to that on the Bible of Real Estate.info. And so it shows up. I get it every day. I get a little notice in my email that there's a new edition. So Paul's busy.
If you guys take the time to watch this, go back and read that article. Today is what date? The 22nd or 23rd?
22nd.
Yeah.
22nd. You may end up watching this later than the 22nd. But if you go back to the article I wrote and published on LinkedIn and on Facebook, I put an article that you should definitely be aware of the CPA that you are using. This time of year, there are CPAs that come out of the woodwork and advertise on Facebook and say, we can get you back $5,000 if you use us and let us do your tax return. Pardon my French. Bullshit.
Yeah.
They're going to put you in harm's way.
Yes.
And you don't want them to do it and then bring an IRS audit upon you. Now, I'm not scared of the IRS. I ended up getting 10 no change audits in a row. But you're not me. All right. I was a New York Jewish boy who grew up, and that's a certain type of personality. But if you hear IRS, you're going to be scared and be worried. And I don't want you to go through that. And all you're going to have to end up doing is give the money back to the IRS with interest, with penalties. And if these people who prepare the return go so far over the edge that it's deemed to be, I forgot the word, but if it's really bad in what you do, they can come back and audit you forever. And you don't need that in your life. Just think about good things, not IRS audits.
Yeah, no, we could try to avoid that because they're probably not going to provide free room and board. Yeah.
You joke. That's a scary concept there to me.
That's not a joke.
But one of the other things too that we touch on cost segregation, and there's just a number. I don't know what time permitting, and maybe we can, in future podcasts, sort of break this down and speak in case study format, taking a specific asset and really breaking down the cost savings and kind of see where the audience and the interest starts to lie. One of our most recent items that we have that we're bringing to make available to builders and developers is using a mesh tape solution called GreenZip. And essentially what that does is it goes over between the drywall and compost with a mesh, and it allows for that wall to be demountable. The whole purpose being there is that there are tons of drywall that's going into the
Trash.
into the trash every single day. And so one of the things, again, in their infinite wisdom, they looked at and they gave this solution to be applied, which normally you can't take and include walls. Not anything. I'm not talking about load-bearing walls to main structures, but all the other walls, they would be considered the full 27 or 39 year time frame. Now, just by applying this tape solution, they've gone down to a 5-year tangible property. That's
bonus depreciation.
And bonus depreciation. That is huge. And so now we're talking about the ability to offer developers and builders and renovation if the project is large enough. It really starts to only make sense with large projects, but that's all we have going on now in that space, primarily anyway, with multifamily and office buildings, etc. Between 5 to 10% savings of the construction cost. That's huge.
Amazing.
So we could really start to peel the onion in a way that would really offer some enlightenment into the whole idea of really taking depreciation analysis to another level. And we really like to get that opportunity with you listeners.
You have absolutely no idea how much is out there, how much savings you can have, how much deferral you can have, and it could change your life. Literally change your life.
No, that's great. And I think, Fred, that was a perfect suggestion. I thought we could have got into some case studies today, but maybe next week we're going to do in the second part. We can do a specific case study, go through everything line by line, really, in a lot of detail, and that I think that will be a great benefit to the people who are watching this.
You mean I have to do homework?
Hmm?
You mean I have to do homework?
No, yeah, I'm sure you can make it up on the fly, but you can you guys can talk amongst yourselves and come up with one specific thing that you want to use as a case study, right?
By the way, I as Greg mentioned before, I do speaking engagements, and I was a university professor for 6.5 years, and I do the speaking engagements on cost segregation, on all sorts of investing in commercial real estate, which is what Fred and I concentrate on. And it's fun for me because I will get the audience involved one way or another. Unfortunately, you see a little thing behind me. That's my walker. I have back problems. But I will take that on stage and I will walk back and forth and I will have people come up from the audience and have discussions like this one with them. And it's a fun thing, but you're going to learn a lot.
For sure.
And those will be published on the info website when they happen.
Yeah, the Bible of Real Estate.info. So that's a place. There are links to your websites and your email address, various things. That's a good place to go. And also, if you sign up, get a preview of the Bible of Real Estate, you get on a mailing list, and we'll send you notices about when Fred and and Paul are appearing, and also other shows they might be on, and all that kind of thing.
I like it. It's like Indiana Jones all over again.
Indiana Jones.
or 007 when it was Sean Connery.
So is the giant ball rolling down to roll over top of you the IRS coming after you, or what?
Hey, it's a good example, let me tell you.
Wow. Yeah, let's not do that, you guys. Talk to Paul and Fred. Don't get involved with the IRS. You know, make more money more easily and more simply, and know that these guys know what they're doing, and they're not going to take you for a walk in the park that ends up with the IRS. You don't want to go there.
And also, don't go to these people that
That's what I'm saying.
advertise that. I mean,
That's exactly what I just said, Paul.
it
Don't go
scares
to those
the
guys.
hell out of me.
Go to you guys.
Yeah, the Facebook expert gurus, right?
I've got to tell you, years ago, people were doing what was known as tax shelters, and they would have you invest like $25,000, and they would give you $250,000 of deductions, and the IRS would just let it sit out there and go on, and then about 2 or 3 months before the statute of limitations is supposed to expire, they send you a bill. They send you a bill for the income taxes that you took that you shouldn't have. They send you a bill for the interest at exorbitant rates, and they send you a bill for penalties like you wouldn't believe. And you don't have a lot of time. Excuse me.
Don't do this.
You don't have a lot of time to answer that. So you are forced into signing an extension of the statute of limitations, giving the IRS all the time in the world to go after this tax shelter because it's not economically feasible. And then you will end up paying all of that. You will end up paying for an attorney, and you're not going to be a happy camper.
No. And most of us are not like Willie Nelson. We can't just have a big concert to pay our tax bill.
Right. For sure. Anyway, I think we've about run the gamut today. We will discuss this also next week. As the guy said, let's get into some specifics and some case studies so that you understand it better. You have to understand this if you do any commercial real estate. It's a must. And so many people. And I've been knocking the CPAs, but the commercial realtors and the commercial brokers and even the commercial lenders don't know about this stuff.
Yeah.
They overlook it. I mean, it's understated. I'm a commercial broker, and you talk to some of these guys and gals, and it really they're not seeing the forest from the trees. This situation helps you if you are selling, if you're listing someone's real estate. You know, having that study run on what that projected sale price is, and then based on how that depreciates out, is huge for the incoming buyer. It then becomes a point that the potential buyer can look at, help them with their financing, or give them other financing options if they're in need of them. It does a lot of different things for the mortgage and commercial lenders and investors. It's just yet another tool, because depending on where you're at in that capital stack, on how you're going to take that deal down, you need to have all the options available to you. And in so many cases, as my partner alluded to, the tax savings piece of it, we just don't look at. And that's something you can take advantage of on the front end as you're walking into a property. Timing and all. We've seen folks save tremendous amounts of money going in on the buy, and it's a common statement in real estate is you make money when you buy.
There's something else we didn't talk about, and we will in future sessions. You are an investor most of the time, but if you follow certain rules given by the IRS, you can be what's known as a real estate professional and then the whole thing is opened up. But we're
Whole
not
enchilada.
going to do that right
The
now.
whole enchilada.
That will be at another time.
No, that's perfect. And the other thing is, I would invite our guests to come with their questions. So if you come and you have any questions,
Absolutely.
Fred and Paul could answer the questions, and that could lead to a discussion of the situation that you're looking at right now, which is your invitation, right, for everybody daily to come and talk to you about what you're looking at and get some insights before getting into trouble.
Without a doubt.
Absolutely.
Yeah. So I think are we good? Any more questions or comments for now?
No,
I think we've beaten up this one.
So we'll see you next week.
Same time, same station. When I was a little kid, I would get up on Saturday morning and I would watch cartoons, and then they would say, and come back next week at the same time. And I would run into the kitchen and look at the clock, and it was the end of the show. So it was the end of the half hour. And then next week I would turn it in the same time, and I got the same thing. Just come back next week. I didn't see the show.
Yeah, same bat time, same bat channel.
Boy, you guys are sure dating yourself with all these memories here.
Oh, there we go. Yeah,
it's called experience, Fred.
Yeah, we could probably tell F troop stories too, but that's another thing. Okay, stop. Make them stop.
I love it. I love it.
Yeah. Okay. We'll see you 11 a.m. Pacific every Thursday, and come back for the Paul Levine Show, and you'll learn an awful lot, and maybe even have some fun too.
This is, by the way, if you ever hire us for anything, this is the way we are. We call it the frickin' frack show, and we enjoy it, and we know each other so well that he will start a sentence and I will finish it, or vice versa. And it leads to opening up all of the information, and we communicate. Like I said, I was a university professor for 6.5 years. I know that I have to teach you everything because I don't want to make decisions for you. I have to make you the informed realtor, or not realtor, the informed investor. Because if I don't make the decisions, you do, but you have to know what your choices are.
Okay.
Say goodbye, Gracie.
Yeah. So come back next week for more fun with tax.